there's some fresh reports coming out this afternoon, right around 12:15 p.m. Eastern, that Trump is pushing aides to go bigger on tariffs as key deadlines near the Washington Post. I mean, it just doesn't, really stop with Trump. There's a 24-hour news cycle that's 7 days a week. And before we go any further, please remember to like this video, share it with your friends, and please remember to subscribe to this channel so we can continue to grow it out in 2025. Clearly, we can see Bitcoin breaking down this afternoon, another 3% following yesterday's 3% decline. Here's your flag pattern, I guess, and it looks like your break. We'll probably keep an eye out to see if we undercut this low at 76,000. Believe it or not, there are CFDs that trade during the weekend. IG is one such place, and they have this index called the Weekend Wall Street, and that's showing you just a 25 basis point decline. This is the equivalent of, I think, the Dow. You can see 42,000. Then if you look at the Weekend Tech Index, which is the equivalent of the NASDAQ 100, it looks like it's trading down about 30 basis points. So I look at these just to kind of get a sense of where futures may open on Sunday night and to give me a sense of what, is happening over the weekend. If you're kind of like wanting to get a feel for how the market may be responding to something, Bitcoin is probably the best gauge overall, and clearly a 3% move in Bitcoin is suggesting the market doesn't like those headlines. But there's going to be a lot of other news this week too, and what I was going to focus on was going to be those data points, and then we'll try to get into some other stuff with the technicals in the S&P, which I thought were pretty interesting on Friday. ISM manufacturing, we're looking for 49.5. JOLTS, we're looking for 7.6 million, down from 7.7. ADP, we're looking for 105,000, up from 77,000. Jobless claims 225,000, basically flat. Services, we're looking for 53, down from 53.5. Non-farm payrolls, we're looking for 140,000, down from 151. Unemployment rate 4.1%. So I put together some of these charts for us, just kind of going through and finding the stag and the flation. So I decided to start with the flation part and come back to the stag part later, because I know that was something that was kind of highlighted. I remember at one FOMC meeting, someone asked Chair Powell about stagflation, and he said, I don't see either the stag or the flation. So I thought it was kind of a funny thing to go off of. So what we're looking at right now are the 6-month annualized growth rates of, PCE. We're looking at core, we're looking at services, and we're looking at goods. The goods component is really the part that's rising now. You can make a case and say, core has certainly turned higher and services has been trending higher now for some time. But clearly the big movement we're getting now is in goods. And that's important because goods have been really adding to the disinflation narrative now for some time. And, oil and energy have been the other piece to it. And if you're losing the goods component, which is, it makes sense when you think about tariffs and people importing ahead of tariffs and all that other stuff. It makes sense to see goods going up, and it is very logical to think that maybe they continue to go up. And this is certainly, kind of evidence also and supported by the idea that we've been seeing these Fed regional survey data points suggesting prices paid are rising. At least so far, we've gotten New York Fed, Philly Fed, and Kansas City Fed all pointing to higher prices paid in the month of March, following now a couple of months of rises. And the only one we're really waiting on now, or that I'm waiting on, is the Dallas Fed, and that should come out Monday morning from what I understand. And of course, 2-year inflation swaps are certainly breaking out to the upside. Here's your ascending triangle. That's clearly broken out to the upside now. And, we took out even the highs of mid-February. So obviously inflation is getting, priced back into the marketplace. This is certainly your inflation part of the story. And obviously we're going to have a job report this week. And, the Fed regional survey data points are pointing really to weaker employment in the month of March. The only one that showed an improvement was the Philly Fed manufacturing survey. Otherwise, most of the data points are showing a weaker employment picture, at least for the month of March. And when we look at, what's really been happening with the unemployment rate is that, the unemployment rate in terms of people losing their jobs has certainly been pretty stable. In fact, if we go back, you can see going back to July of 24, the number of people losing jobs has actually been fairly stagnant, but the people who are entering the labor force has been rising, and this has been sending and that's really kind of allowed the total unemployment rate to stay pretty flat. And that's why you're not really seeing things like continuing jobless claims go up, despite the fact that you have the number of workers, the number of unemployed people increasing again, because this isn't really about people losing their job yet. This has been about people entering the workforce. The problem is, obviously, is we don't know what the impacts of the government cuts are going to be, if they're going to show up in March or not. And if they start showing up in March, well, then there's a reason to think that maybe the unemployment rate that's being priced in at 4.1% is too low. And when we look, Kalshi is actually suggesting the unemployment rate rises to 4.2%. Now, that had a great call on core PCE. Last week, we highlighted that 0.4% number that this was looking for on a month-over-month basis, and that's exactly what we got. So, this is a 4.2% number. This is what they're looking for. This is an important thing to be aware of, because if you get a hotter unemployment rate and you get sort of subdued employment growth, which is what's being forecasted, and you get these inflation price points that have been kind of building, which is likely to show somewhere in the ISM manufacturing data or the ISM services data, building and nervousness around a stagflation type of environment. And that's really going to continue to be bad news for the equity market. Now, at least on Friday morning, we had done an update. We were talking about the S&P 500 selling off at that point. Obviously, it got a little bit worse, as the day progressed. I think when we did the update, it was around, 10 o'clock, 10:30 in the morning. So we continued to sell off throughout the day. We kind of flatlined going into the end of the day, but we managed to close fairly flat to where we were around 1:30. It's not unusual to see, selling continue from a Friday afternoon. I think it's very telling that we got up to the 200-day moving average and failed and came back down through the flag pattern. And, again, it depends on how you want to measure this. I like to measure it from where it breaks. There are some people that measure it from the top. I just happen to like doing it this way. It suggests to me that maybe we see a decline in the S&P 500 to around 5,050, at least based off of this pattern. If you do it off of this pattern, if it plays to completion, you're talking about 5150 or so. So, there's a potential, if this is actually a bear flag, it actually plays out in a meaningful way, and it really results in a much sharper decline. And I think, again, when we kind of look around at the market, on Friday, you saw the Japanese yen also kind of getting very close to breaking down again outside of what looks like a bear flag here too. And basically what you're seeing, and a reason for this, is because you're seeing 10-year rates moving sharply lower. And at this point, the market, the S&P, is really just trading with interest rates. And the more interest rates go down, the more the equity market seems to follow. And this could be because the market is trading with interest rate differentials and the currency pairs are trading with rates. Or it could just be the market's looking at the 10-year rate as a growth barometer and saying growth is going to be slower in the future. And so therefore, stocks are going to go down. Or it could be the fact that money is rotating out of stocks and into bonds. And that's another sort of way to think about it. But what is clear is that as of right now, stocks are trading with bonds, and if bonds continue to drop, then we're likely to see, the equity market kind of go with it, at least at this point. The other thing I wanted to point out was that breadth on Friday was really weak. And the other thing, obviously, is that the New York McClellan oscillator turned back down below zero. And really more importantly, is that the New York summation index also turned back down again. I had done a video on this over the week for members and kind of got into the details as to why I use dots. But what's really more important here is that you saw that the move between this dot and this dot was a little bit wider and a little bit bigger. Certainly not as tight as these dots here as we were rising. And this would suggest that maybe you're starting to see a real serious move lower, and that you're going to see some more velocity to the downside. Certainly, if we were to get another big down day in breadth, that would probably indicate that the dots are moving even faster, something that looks more like this or something that looks more like this, which would suggest that this down leg has really initiated and we're going to see further downside to this market. So I think that, there's a lot of things going on this week. Obviously, tariff news is going to be a big a big piece of it, and that's always going to be something that's going to really be dependent. But obviously the market's going to really be also kind of glued to what this economic data starts looking like. And despite the big decline that we saw on Friday, you really didn't see the VIX move. And that, I think, is very important in its own right. It could imply that the selling that we're starting to see again is just really the beginning of something, and you really haven't even reached some sort of capitulatory moment yet in this market. I know a lot of people think that April 2nd may be a sort of a capitulation moment, but that may not necessarily be the case, at least based off of where the VIX closed on Friday at 21. I mean, another way that I sometimes will gauge this is by looking at the VIX versus the VVIX, and when you look at it, this was October of 22. I mean, we're nowhere even close to that. And I explained in one of the videos why I use this method as opposed to just looking at the VIX only, because in October of 22, you never got that capitulatory moment, but you got the capitulatory moment when you looked at the VIX relative to the VVIX. And that's why I sort of now look at this thing. Also, implied correlations were up a little bit on Friday as well. I mean, these are still kind of relatively low, actually, and don't really suggest we're at some sort of capitulatory moment either. So I would kind of, when you look at implied volatility and correlations, they sort of suggest that this could go much further. When you look at the technicals, they also suggest they can go much further. And it's really going to depend a lot on, how the data continues to come out.